In the past, we talked about absolute assignment, and as I said, an absolute assignment, basically, we basically said the policy's gone, and that's all there's to it. So sometimes what happens, a person doesn't necessarily want to simply get rid of the policy, but they would want to collateralize the policy. In other words, put a lien against the policy. The bank itself may request that. If you go back to them and say, I want to borrow some money, they may, in fact, say, well, that's fine, but we need an insurance policy on you. So in this case here, what we're going to talk about is collateral loan, but we're going to do the collateral loan not for personal purposes, but we're going to use it for business purposes. So because it must be essential for business, in other words, in order for you to get any kind of deduction of that premium, it must be a situation where the bank demands that you have an insurance policy on your life and you collateralize that policy. Otherwise, they won't give you that loan, basically. Okay, so in other words, they're basically saying is a loan is available to you. However, we want security, and so therefore they give you a letter and all that sort of stuff there, so they can prove that in actual fact this is essential to the business. So therefore, we'll give you that $200,000. So here's the example. We've got Jeff sitting here, and he needs to borrow $200,000. So the bank said, that's fine, that's not a problem. However, we want you to have a life insurance policy on your life and assign it over to us. Jeff says, well, I happen to have $500,000 on my life right now. Okay, so it's not a problem. I can collateralize that policy. Now, at the time when he assigns this to the bank, his adjusted cost base $160,000, and the CSV is $250,000. The premium is $12,000 per year. And the net cost of pure insurance, very important, okay, net cost of pure insurance is $3,200. So what we're saying basically is that because this is collateral, okay, even though we've got all this information, really we don't need it. In other words, there is no deemed disposition when you're doing a collateral loan. In absolute transfer and absolute assignment, there was a deemed disposition. So we would have had a problem here between the 160 and the 250, basically, as a policy gain. But because we're not really giving this policy away, in other words, you still own the policy, you haven't given the policy away, the beneficiary is the same, the whole bit. All we've done is we put a lien against the policy demanded by the bank itself. Okay, so that's all we've done. So therefore, in a collateral loan, there is no deemed disposition. There's simply a collateralization, in other words, a lien again against the policy. So now the question really is, because we are going to be using the $200,000 for the business, can we deduct the premium? Well, we can't deduct $12,000 premium. Okay, that $12,000 is for the entire $500,000. But furthermore, under the new Income Tax Act and everything else, in that $12,000, remember, is cash value. Okay, it's particularly with universal life, for example, right? There will be cash value. That's how we get these numbers and everything else. So basically, the Income Tax Act is saying, no, you can't deduct your premium, but we will allow you to deduct a portion of the cost of the insurance. In other words, the actual cost of insurance itself, the NCPI. Yes, there will be a deduction for that. How much, however, depends on your loan. So in this case, the loan is only $200,000, which basically means that he's only borrowing 40% of the $500,000. In other words, here's your $200,000 divided by $500,000, that's 40%. So really, the loan represents the lien, you might say, represent that up to $500,000. Only 40% is actually being used as collateralization, so the lien is only 40%. So therefore, because you're only doing 40%, you can't deduct the entire $3,200 because that $3,200 covers the entire $500. But you're not using it for about $500. You're only using $200,000. So therefore, it's proportionate, basically. So we need to figure out how much of the loan and how much of the original policy. So in this case here, we're only using 40% of the original policy, not the entire policy. So as a result, in order for us to make a deduction of the NCPI, it's 40% of the NCPI, which is $3,200. So therefore, they can deduct $1,280 a year can be deducted for business purposes. Now remember, and over and above that, of course, there will be interest on that loan, of course, because it's business for business purposes, they can deduct the interest on that loan as well, okay? But from my perspective, can they deduct any portion of the premium? The answer is yes, but it's not actually premium because in there, like I said, is cash value, but it is the actual net cost of pure insurance. Now, the reason why we do this is because people may have different kinds of policies. They have universal life, they may have whole life, par, non-par, they may have term insurance, okay? The point is that regardless of the kind of policy that's actually being assigned, the NCPI is always the same. In other words, the cost of dying is going to be the same whether you buy a whole life policy or whether you buy a universal life policy. It doesn't really matter, okay? So therefore, that's why we only allow the NCPI. We don't allow the entire premium. It's only the net cost of your insurance. That way you can use any policy you want, because when that time arrives, all you need to do is phone the insurance company and say, what is my net cost of your insurance? The company will send you a letter to that effect, and therefore, based on this here, information here, for example, you can deduct a portion of that, okay? Now, sometimes what happens, of course, for business purposes, there may be that the $500,000 may be curated term insurance. In other words, it's not universal, it's not whole life, in other words, there's no cash at all, okay? And so therefore, it's only term insurance. So when you're doing term insurance, the cost of insurance and the actual premium are sort of pennies apart. And so therefore, in that case there, it's not a big deal. And so therefore, generally speaking, if you're using term insurance for collateralization, the whole premium is deductible because the NCPI is very, very close to the actual premium itself. But when you're using whole life or when you're using universal life, the premiums could be quite substantially bigger than the actual NCPI. And that's why they're saying the rule is very, very clear that if you're going to use this for collateral purposes, then the only portion you can use for deduction of premium will be the net cost of pure insurance.